Welcome back. Let's get a corporate conversation going now on Trading Hour. UCO Bank is in focus following its fourth quarter business update. The bank has reported a 5.6% growth in deposits on an annual basis, while the credit to deposit ratio has improved to 74.8%, which compares with 67% same time last year. To talk about the way forward, we have Ashwani Kumar, Managing Director and CEO of UCO Bank, joining us on the show now. Thank you very much, sir, for joining in. This is Rima here. If you could give us an indication of your deposit growth, it does appear slightly on the weaker side compared to what some of your peers have reported. Is this a cautious stance taken by the bank given where your CD ratio was? And what's the outlook on deposit growth? Would you be more aggressive in mobilizing deposits going forward in FY25?
Thank you for having me on the show. And you are right that was a conscious call by the bank because our CD ratio was lower. It was hovering around 64% earlier last financial year. And now our intention was to increase our CD ratio, and we have excess SLR securities, and we have disposed of certain securities, and liquidity has been used therein. And top of that, we were using that under the TAPS market also to raise funds from the local market. So that was a conscious call. We did not raise any CD also, and we did not go for the high cost deposits during last year. And our main focus continue to remain on CASA, and going forward also, our focus will be on CASA and for improving our CD ratio. And looking at the current economic environment and the liquidity in the market, deposit rates have slightly come down. And now bank has started a little bit of focus on the deposit front as well. And we expect the deposit also to grow. And once we reach to around 74 to 75% of CD ratio, then we will take a call to go aggressively or to not.
Okay, sir, thank you. You answered the immediate question that was on my mind, that what is the targeted CD ratio? So you're saying you'll go up to 75 and then take a call. Talking about deposits, I mean, the growth has been quite healthy. Year on year, domestic deposits are up about 3.7%. Your CASA ratio right now stands at just below the 40% mark. Now, is that a comfortable zone for you? Would you like to increase it from here on as well? How comfortable are you with respect to the deposit position? And then CD ratio, will you keep it to below 75% and not go above that?
See, if you talk about CASA, historically, if you look at our numbers on a quarter-to-quarter basis, our CASA ratio was around 37 to 38% hovering around. This is the quarter where we have touched 39% CASA ratio. And our endeavor will be that on a sustainable basis, we should increase our CASA ratio, and we should cross 40% in this financial year, current financial year. That is on the CASA front. Second, on account of your CD ratio, I have already spoken that our intention is to reach first 75%, and that is also a number we need to achieve, because historically, again, if we look at our CD ratio, it was around 64, 65, and if you talk about somewhere 2 years back, it was around 59% only. So slowly and slowly, bank is inching and improving its CD ratio. And it will help not only in net interest income, but also to improve our margins going forward and operating profit as well.
Okay, so since you're talking about reaching 75% on CD ratio, let me turn the conversation to growth in the book. Growth in advances is very, very healthy, above 15% year on year at the end of the fourth quarter. Even sequentially, the growth is 4.5%. So just give us some more perspective on where the loan growth is coming in from, which are going to be the big focus segments for you as we step into, look at the first quarter of the new fiscal and beyond.
See, if you look at our loan growth composition, the mix, our RAM, retail, agri, MSME mix is around 61%. And we are continuously increasing, proportionate increase in all our segments. When we talk about around 16% increase in our credit growth during this financial year, our retail, agri, MSME all have grown reasonably in the similar lines, as well as the corporate credit growth. Previously, in earlier years, our corporate credit growth was not healthy, and we were lacking in the corporate credit. This year, our corporate credit if you talk about the demand is coming from around all the sectors, maybe steel, maybe textile, maybe energy, and maybe when we talk about retail, particularly home loan segment and car loan segment has also grown very well. And going forward, when we look at the economic environment, high frequency indicators as discussed by our honorable governors are also during the RBI MPC meeting, all economic indicators are showing a robust growth, and we expect the growth momentum to continue, and the bank will continue to strive to achieve the credit growth as well as we have done in the past.
What's the loan growth that you're targeting, sir, in FY25? And if you could break that up in corporate and retail?
See, our guidance for the previous year was around 12%, and we have achieved around 16%. And when we talk about 16%, it is in similar proportion almost all the segments: retail, agri, MSME, and corporate. And going forward, also our guidance will be around 12 to continue the same guidance of 12%, and with the same proportion, 61 to 62% our RAM, and around 38-39% should be our corporate credit, and the similar growth percentage should be across all the segments.
Any risk cropping up on the asset quality on the horizon?
See, if you look at our slippage ratio, last year our slippage ratio was 1.75% on a yearly basis, and this year we had given a guidance of 1.25%. Till December, we are within the guidance, and I expect that when the audited numbers are out, so we expect to maintain our guidance that our slippages should be in this range only, whatever guidance we have given. And going forward also, when we look at our SMA book, as you can see our December results earlier, since March is under audit, we will be able to declare March SMA levels and stress levels once the audit is over. But our SMA percentage has been consistently coming down on a quarter-on-quarter basis. And similar trend I expect to continue in this quarter and going forward also. And similarly, the slippage ratio, which is hovering around 1.25 now, we expect that we will, once the numbers are out, we will be able to give you the guidance for the next year as well.
Okay. No, fair enough. I know we can't get into too many specifics, sir. That we'll do at the end of the fourth quarter numbers declaration. But just in terms of directionally, since we're talking asset quality, will FY25 be a year of big recoveries? I mean, from the NCLT, or just directionally, what's the asset quality trend and recovery trend for FY25?
See, asset quality, if you have to see on a quarter-on-quarter basis, if I talk about my bank, our gross NPA ratio was 4.72% when we started our year 2023-24. We had given a guidance of 4% that will come down to. In December itself, we have breached that level. We are 3.85. And we expect that this quarter, our gross NPA will come down further. Similarly, net NPA also has come down from 1.29 to 1.85 in the previous 0.98 in this December quarter, and expected that it will come down. The same trajectory is expected to continue. If we talk about NCLT and big recoveries, I think big recoveries in NCLT will not be there because all low-hanging fruits have been encashed earlier years and last year. There are few big accounts which can be resolved in next year, and our recoveries will be mainly from other than the NCLT also, where we have a TWO portfolio, we have gross NPA on our book. So effort will be for the upgradation of last year's slippages and also from the TWO book which we have already created.
Thank you very much. Look forward to chatting with you once your Q4 numbers come out. That's UCO Bank for you.